Welcome to Pitch Your Firm. I am your host, Marc Howard, and today we have a very unique guest. Today we have Eric Rabinovich of Live Oak Bank. And now it's a little different from our usual discussions, and you may be wondering, why do we have a banker on the show? This is going to be a very interesting show because there's a growing trend in firm acquisitions, buying, selling, but how do you actually come up with the capital for that? How do you actually figure out ways to make the most of these endeavors? So we're going to deep dive into the entire world of this. Eric, welcome to the show. Why don't you take it from the top? Maybe give us a quick little background, 30-second background or so, and then we'll deep dive into some of these questions.
Excellent. Thank you for having me on. I do want to just say I really love your show, and I'm not just saying that. I came across I think it was through LinkedIn, came across your profile 3 or 4 months ago, and I just think you put out really great content. So thank you for the time and effort you put in. I think you provide a lot of guidance and valuable data and just really interesting content. So I'm really happy to be here, and thanks for having me. So I'm Eric
Sure.
Rabinovich. I'm a loan officer on Live Oak Bank's professional services lending team. Live Oak Bank is probably best known for its SBA 7A lending. That being said, if someone's interested in buying a firm or just pursuing capital, it doesn't have to be an SBA loan. So we'll get into that. But I focus exclusively on professional services firms, and primarily it's accounting and tax. We'll do a little bit of engineering, design, legal law firms, but it's really 99% of my time is spent talking to CPAs and accountants. And even more within that, it's primarily M&A. Occasionally, it might be an owner-occupied real estate deal or debt consolidation, debt refi, but by and large, it's M&A. It's myself, my colleague Steve Pietkowski. That's our focus. We really love what we do. We love the industry. I'm a former Big Four employee, so I have a lot of familiarity with the industry. And Live Oak also focuses on industries. So in addition to professional services, we have other teams that focus on other industries. But that's a little bit about me, and looking forward to the conversation.
Yeah, we have a lot of stuff to unpack here. And some of the terms you mentioned, the 504 loan program, a lot of these things may be Greek to some of our viewers. So I want to take some time to dive into sort of different programs that are offered, what's going on out there. But first, just stepping back, because you mentioned you were at Big Four, I believe PwC, supporting their SBA $30 billion 504 loan program. So maybe we can start with the whole idea of different programs. What exactly is a 504 loan program, and why should accounting firms, particularly that may need capital, be interested in something like that?
Yeah, so it's a common question. I'd say more of the attention probably is on the 7A program, but starting with 504, the numbers are not completely random. They're references to the regulation where these loan programs were essentially announced, designed by the Small Business Administration.
Sure.
And the main difference between 504 and 7A is 504 is primarily for real estate loans, but the structure of the loan is really the essential difference. So an SBA 504 loan is actually a combination of a few different instruments, debt instruments. So firstly, the general structure is 10%, and that's one of the first differences. You have to bring as a borrower 10% into the deal. That's the minimum. There are some cases, if it's a special use property, that you have to inject a higher amount, but then 40% is coming from the SBA, kind of. And I say
Mhm.
because the SBA essentially facilitates a bond sale. It's a debenture. So they go to the open markets, they do one sale per month, and so that makes up 40% of the loan. And then the other 50%, the remaining 50%, comes from a bank. And it's technically a conventional loan. The reason banks like it, and it's also a great deal for the customer, for the borrower, is because the bank is in a first position lien, but it's only a 50% loan to value risk profile. So that's an uncommon deal profile if you're looking in the general real estate conventional market. But it's wonderful for the customer, and more importantly for folks in your audience who might be listening. A 504 loan is a great way to get good terms. It's a 25-year term and amortization. There are some prepayment penalties depending on the terms of the loan. which can vary. Keep in mind, 50% of the overall debt is tied to the bank product. So there can be some variations, but that's generally the main overview of a 504 loan. It's really primarily for real estate. You can't use it to acquire a firm. Generally speaking, there's a few exceptions to that. The last thing I'll mention is with the 504, you can also use it for equipment financing. It's really anything designed to have a life over 10 years. But that's it. I don't personally do a lot of 504s these days. Most of the accountants and CPAs we work with, they're leasing. We do an odd one here and there, but it is a great product.
So it would
Yeah,
be applicable for purchasing, let's say I'm looking to buy a firm and maybe real estate came with that, the building, it would be applicable for that and some of the equipment with that as well.
100%. And we can do a 504 loan in side by side with a 7A loan. So I have seen and worked on deals where there's an M&A transaction. So if someone's buying the goodwill, there does happen to be real estate attached to it, and you can do a 504 loan with it. You can also include that, and it's probably more common if there is real estate. It's just bundled into the 7A loan. But yes, that's exactly right.
Yeah, and I think there may be some interesting things to do with that. Obviously, there's, with a lot of tax accountants that are listening,
Yep.
various bonus depreciation strategies and things like that. So there's definitely some opportunities there. Let's talk about the 7A loan in particular. And obviously, I'm trying to be as unbiased as possible. Obviously, you're working at a bank, but let's be general.
Yep.
General 7A, why should an accountant? And let's just try to be specific. Let's just say I'm an accountant. Maybe I'm looking to expand and maybe I want to acquire another practice. Let's say I'm looking for a loan, say maybe $500,000. Walk me through 7A and how it could be applicable to that particular example.
Yeah. So firstly, I mentioned the structure is very different than a 504. So an SBA loan, 7A loan, it's a government guarantee lending program. So structurally, the main difference when you contrast that with the 504 loan is the bank is making the entire loan here. So there is no direct involvement by the SBA like with the 504. By the way, I didn't get into it, but technically with the 504, it's not the SBA directly. There are these entities called certified development companies, but they're essentially extensions of the SBA. With the 7A loan, the bank is originating 100% of that debt. However, depending on the size of the loan, and in some cases, the type of loan being made and the type of business that loan is being made to, the government will guarantee up to a certain percent of that loan. Typically, that's 75%. So if you take a $500,000 loan in your example, while the bank is originating $500,000, their exposure in that scenario is only going to be about 125,000. It's meant and is designed to incentivize banks to make loans on terms and to borrowers who wouldn't otherwise qualify for conventional debt with those terms. It is also a very flexible program. So I'd say starting with the biggest difference, in my opinion, I mentioned that 10% injection with the 504 loan. You don't necessarily have that with the 7A loan. It depends on the type of loan you're making. So if you're making an M&A loan, you do have to generally put 10% into the deal. Now, there's flexibility on how that 10% is accomplished. It doesn't necessarily need to be cash from the borrower, but you also don't have to necessarily use it for an M&A transaction. You can use it for debt
Sure.
refi. You can use it for buying real estate. You can use it to buy equipment. You can use it for working capital if you have some strategic hires on the horizon. There's a lot more flexibility, and that's probably why it's more popular. It's also just a little bit simpler to just deal with one bank. If you're making a 7A loan, you're just dealing, it's one entity. You don't have to deal with the SBA. You don't have to deal with another bank. So there's fewer cooks in the kitchen, so to speak. So it is a little bit more of a smoother application and origination process too, which I think is another reason folks tend to like it.
Now, you would think that most accountants would understand the importance of working capital, and most do, of course. It's particularly important when it comes down to loans and figuring out exactly how much you'll need for, let's just say, another firm acquisition. Maybe you can talk a little bit about the importance of working capital, particularly for seasonal businesses. Maybe there's like this whole buzz during tax season, a lull during the summer months. How does the loans come into the working capital situation?
Yeah, it's a great question. And in this industry, it's a very common challenge, I think, that accountants, especially tax professionals, have to deal with. So working capital, it can really derail a business. I've seen it, and unfortunately, I've seen it actually cause businesses to have to shut down. And all it really is a timing issue, right? So we tend to attach a line of credit to a lot of the deals we do. So you'll have a term loan with a line of credit. It's a revolving line of credit. There's multiple ways of dealing with working capital. I will say one of the things that banks who are making a 7A loan that they have to do as part of their underwriting process is a working capital adequacy analysis. And that's something that I do and my team does when we're working with a customer. But it's really essential to understand when you look at your calendar year, what are your busiest months? What are your slowest months? What's your cash burn, right? And you can have a fully profitable business that does very well, has high margins, but strictly just based off the timing, if you don't have a plan in place and capital, however it doesn't have to be a loan. Again, there's multiple approaches here, and we'll talk through some of them. But if you don't have a plan in place for how you're going to bridge the gap from those busy years to the or months to those slower months, if you run out of cash, it doesn't matter how profitable your business is. It doesn't matter how much your customers love you. You can go under if you don't have enough money to make payroll, to pay vendors, to cover software expenses, whatever it is. Even if you're profitable on an annualized basis, not having a working capital plan in place can really escalate things in a bad way if you don't have a good plan in place.
Yeah. And so it's not to waste anyone's time that may be looking for a 7A. What is the basic minimal criteria? Is it a part of their revenue situation, their amount of like the way that their entity is structured, their credit score? What's sort of like the minimal criteria before someone even wants to start that process?
It's a very good question. It's an important one. And I'll put aside some of the more eligibility related issues. So there's certain types of businesses that aren't allowed to apply for a loan. Let's just assume for the sake of example, we're not dealing or talking about those. But the big things, and I should have mentioned this earlier, but that the 7A product, it's a cash flow based program. And what that means is and I would say this is a benefit to folks who might be interested in applying or learning more about it. It doesn't matter if you have collateral or not. And I not to say that if you do have collateral that it won't come into play, but you don't have to have real estate. You don't have to have fixed assets for the bank to be able to lend against, which is a common requirement in conventional in conventional lending. So the first requirement, really above all else, we'll get into some of the others, but because it's a cash flow based lending program, the business has to be able to support the debt. So whatever the debt service is attached to the loan size that you're looking for and the structure that you asked about a $500,000 loan, if you do a rough calculation, so these are 10-year terms, the annualized, if my math is correct, I did this yesterday, so I could be slightly off, but if the annualized debt service for a $500,000 loan, let's say, is $80,000, something to that effect. So most banks have a debt service coverage ratio, minimum debt service coverage
Mhm.
ratio of around 1.25. The program minimum is 1.15. Nearly all banks have a slightly higher, more conservative minimum. And so my main point is that as a borrower, you have to show historically for the last couple of years that you can support that debt. So that's the most important thing. Everything else could look perfect, but if you're asking for too much debt relative to what the business can produce in terms of positive cash flow, free cash flow, it won't work, right? So that's the number one thing. Beyond that, you're absolutely right. We look at FICO score, we look at the structure of the business, right? Who's the ownership? So one of the requirements with a 7A loan is typically 20% or more. Anyone with ownership of that amount or more has to provide a personal guarantee.
Sure.
So that's another requirement. Beyond that, there is actually quite a lot of latitude that lenders are they're given by the SBA for loans below 500,000 up to and below 500,000. If it's above 500,000 currently, those rules become a little bit more stringent. These are relatively recent rule changes. By the way, one important caveat to all of this, we have a new administration here in the States who just took power, took office. All of this is subject to change, right? They seem to be very intent on making a lot of changes. And so we don't know yet how that might impact SBA rules, but just keep that in mind. I'm talking to you today on late February 25, so this is all subject to change.
Sure, sure, yeah.
Yeah.
And yeah, it looks like there are some recent, I believe, some changes that happened in December for some of these SBA loans as well. So it seems like these things are always in flux. Now, because you mentioned that this is more a working capital loan, let's and I like to go through like examples and hypotheticals because
Yep.
otherwise we can get, lost in the numbers. So it sounds like this is more a loan for folks that maybe accountants or firms that have an established practice, maybe not so much for newer firms, or let's just say maybe I'm coming from the big four. I want to go out on my own, start my own practice, but I don't have any revenue yet. I'm looking for something. How is it geared more or less towards like newer firms? If you can talk about that.
It is. So a startup loan, and I have conversations several times each month with exactly the type of customer that you're outlining. They're coming either from the big four or the top 50. They have a ton of experience and they want to do things their own way. They want to take that plunge into entrepreneurship. It is very difficult, but not impossible to get a 7A loan for a startup. Live Oak, personally, just that's where I happen to work and have worked for the last 9 years. We don't love startup loans, but there are 7A lenders out there. And keep in mind, last year in 2024, about 150 banks in the 7A lending program made a 7A loan to an accountant. There's a lot of lenders in the space. And so some of them do have a higher risk appetite, right? Part of the reason a lot of banks are hesitant to make a loan to a startup is because in these types of industry, in this type of business, there is very little in the way of collateral. We're talking about professional services firms, right?
Sure.
99% of the value most of the time is in the goodwill. It's an intangible asset. And so there is a very important and intense focus on that cash flow piece. So obviously with a startup where there's no historical cash flow. Now, that being said, there are cases where based off the individual, they could be a good profile for a startup loan. Maybe they do have collateral. Maybe they do have something in the way of maybe their spouse has a business that would be willing to sign off and be a corporate guarantor on the loans. These are edge cases, but they happen from time to time. The last thing I'll say though is that the SBA publishes data on the 7A program and they update that data every quarter. I recommend for folks to look at that data. And the reason I say that is because if you download that and you go to the data, you can look specifically at which banks, one of the columns in there is the business age. So you can look specifically over the last year or two, which banks are making loans to CPAs or just accounting and tax professionals who actually are startups. There's a few out there. And that might change from year to year, but it is possible to get it. That's probably not your best option as a startup or potential would-be entrepreneur. There's probably some other options to explore. But I do want to encourage folks, if you talk to one or two banks and they say no, it doesn't mean that every other bank, you might have to talk to a lot of banks before one says yes. But yeah, it is, if I haven't made the point clearly enough, it is hard if you're starting a loan or a business from scratch, it is hard to get
Sure.
a 7A loan. Yeah.
Now, speaking of options, Eric, one other thing, traditionally there's been a lot of seller financing as well as an option versus bank financing. However, now that, and we'll talk about trends in this next segment here, but there seems to be obviously a lot of buyers in the market, right? It's really a seller's market. So is seller financing becoming less popular and bank loans more? Can you talk a little bit about that?
Yeah, it's an interesting thing. I encounter it very rarely, but it does happen. I've talked to enough folks and I listen to enough other accounting podcasts. Dominic Piscopo is one from the Big Four Transparency. He had a guest on late last year, who, for whatever reason, I've been meaning to reach out to him, but for whatever reason was just he has his employee. He's been preparing this individual, and he's decided he has a very specific time and plan in place. I think it was like 2 or 3 years he's selling to this individual. They're not going to involve the bank. That doesn't, in my experience, I can't speak for everyone. I find that is a really unlikely, it's just not really common out there in the marketplace. It doesn't mean you can't be one of the lucky few, but I have to believe it's a fragmented market and the data can be a bit sparse. But I honestly would be shocked if truly 100% seller finance deals make up more than 5% of overall M&A activity in the marketplace. And frankly, it might be lower than that. But that being said, that caveat aside, if you can pull it off, if you can find a seller who's willing to do that, it can be an amazing deal. There's pros and cons, by the way. And to be clear, every option of whether it's seller debt, SBA loan, conventional loan, AR financing, whatever we're talking about, I want to be clear, there is no monolithic correct answer. Really, there's pros and cons to every one of these options, and it really depends on the individual. And so what I like to do generally is, here are the pros and cons, here's the benefits of doing it this way, here are the disadvantages and drawbacks. And with that information, people have to make an informed decision on what's best for them. But a seller note can be wonderful in terms of you don't have to deal with the bank, you don't necessarily have to have covenants involved. You can usually close a lot faster, right? You can negotiate directly with your counterparty without the bank sitting on your shoulder, driving from behind, for lack of a better way to put it. But it is a good option if you can find it. I'm not going to lie. There is some debt. I will say there are some drawbacks to seller debt, which is typically the terms are shorter. So with an SBA loan, as an example, it's a 10-year term. If we're comparing a seller note with an SBA note, and let's say that seller note is 5 years or 4 years, that's a lot more of the business's cash flow during the term of that loan that's now going to the seller. And so that can limit, maybe in that scenario, what the buyer can do with the business. There's less free cash flow, means they can make fewer investments for growth, perhaps.
Sure.
They might not be able to hire as fast as they'd like. So again, there's drawbacks here, but seller, if you can find a deal where the seller's willing to forego bank financing, it can be really wonderful. By the way, it's also could be a drawback for the seller too, right? If they can walk away with 90% of the purchase price after the deal closes versus having to wait for 4 or 5 years, right? There's some more risk that the seller's taking on there. But again, pros and cons, right? Sometimes the seller doesn't want to be subordinate to a bank. And again, there's no one right answer here.
Sure. And speaking of other alternative options, and I'm not sure if this is your wheelhouse or not,
Yeah.
so this might be out in left field, but there's also a growing trend of ESOPs or employee stock ownership programs. Do you see that as a competitor to services that you may offer, or is that an option that you work with in making that deal structure, or how does that come into play?
Yeah, it's an interesting question because it doesn't come up very often yet in the SBA lending landscape, at least SBA lending for accounting and tax firms. But I do think that's going to change. And part of that is you can actually get an SBA loan as an ESOP.
Hmm.
So this is, again, not super common. And I recommend there are some ESOP experts out there in the field that can talk to this a lot more fluently than I can. But I actually view ESOPs generally as a potential counterpoint or alternative to private equity. And I mean that in the sense that, so if instead of an outside firm coming in and buying, let's say, a multi-owner practice, if they agree to have the employees form an ESOP, and then that ESOP can go and get essentially capitalized through an SBA loan. And there's other lending options too, but they're mutually compatible. It doesn't have to be one or the other. I don't know where ESOPs, it's not my area of expertise. I don't know where, like a non-SBA scenario, how ESOPs typically get the capital they need to buy the partners out. But yeah, in that scenario, that could be a competitor option or an alternative option to an SBA loan. But again, it's an interesting thing where in the SBA world, you can actually get an ESOP. And so to do that and basically keep the value in-house with the firm, with the employees, it can be a powerful alternative to private equity. But of course, talk to a professional. There's a million different tax ramifications here doing it that
Sure.
way. And obviously the partners would have to sign off on it. But I do think we'll start my own just prognostication here is we're going to start to see some more of that as there's additional consolidation out there. So I think it'll be something to keep an eye on over the next few years.
Yeah, and speaking of PE and M&A, I want to talk about a bit about valuations. You see a lot of deal data coming across. What do you feel is like those, what are the biggest factors that drive valuation from your perspective?
Yeah, it's a great question. And we get asked this question quite a bit with by borrowers where our customers, they'll ask us,
Yeah, what's my
how,
multiple, right?
what's my multiple? Or if they're looking at a firm, is this a fair purchase price? How much should I be paying? And we have to be very careful because at the end of the day, the lender isn't their job isn't to determine what the value of the business is. Really, our job is to determine, regardless of what the purchase price is, what can the business support? What's the debt
Right.
service? So you can certainly back into a max valuation there. But to your question in terms of what impacts that valuation, what are the factors? Number one, it's going to be your profitability. What's the actual cash flow of the business? This is an interesting point, though, because for whatever reason, and I still don't think I've found the answer to the question, but for whatever reason, in this industry, the sales multiples tend to be at a multiple of top line of revenue. And that is a odd precedent for an industry that's oriented around numbers and P&Ls and digging into the details. But I say that because there's a very big difference between $1 million firm that has 25% net margins and one that has 40% net margins. And those are not and should not, in my opinion, be worth the same amount. But of course, you do have to get into the details and look at the profitability of the firm and look at the changes that might occur post close, right? There might be key employees that aren't part of the go forward plan. There could be changes in the software. There could be big changes in the fixed cost structure of the business. Maybe they have a location with a lease and all the
Yeah.
employees go into the office and the new owner has visions to virtualize the firm. Whether all of these things, whether they apply to the seller and is it a virtual firm already? How do they leverage offshoring, right? What are their labor costs relative to market benchmarks, right? So these are all going to impact the ultimate purchase price. But again, from our standpoint as lenders, the purchase
Yeah.
price, we have to have the business appraised for a certain amount.
Mhm.
So if it's a really high multiple, you can get into issues, even if it cash flows, you can get into issues where it doesn't appraise for as high, like when you're selling a home, right? And in that case, you have to adjust the deal structure accordingly to be able to make things work. So that can happen. And it is happening with more frequency as multiples go up, right? To your point earlier, there are a ton of buyers in the market. It is a seller's market. I am seeing multiples slowly creeping up, not to mention the fact that you've got private equity coming from the top down, from the higher end of the market, and they seem to be having a larger and larger appetite for smaller firms as each
Sure.
year goes on. So I think that's driving some of the demand up and some of those multiples up as well.
Yeah, and Eric, I'm seeing the whole revenue multiple is more of a traditional metric, particularly for firms that are under 1 or 2 million or so, somewhere between 0.775 and 1.2 for a revenue-based multiple. For larger firms, EBITDA would also be a multiple. I'm also seeing multiples based on future cash flow situation. So I think it's becoming interesting. It really depends on how that valuation is calculated, and there can be so many factors, but at the end of the day, it's really down to how much is the buyer willing to pay for that. And one of the factors that I pay particular close attention to is the obviously the cash flow situation, but of that cash flow, what is the percentage of recurring revenue, right? For example, in your wheelhouse, working for a lot of tax firms, I think there's a difference between recurring revenue versus reoccurring revenue. Recurring revenue is I consider like subscriptions, right? So you have like maybe a monthly or quarterly guaranteed, maybe on the accounting side, advisory, bookkeeping, versus like the reoccurring, which is like a once a year, maybe not situation. Let's just say you have 500 clients and you're doing 1040s, right? So that's going to be like a once a year 1040. Likely they're going to come back to you for that 1040, but it's not like a guarantee. I'm seeing a large move to more of subscription-based contracts. From your perspective, does that make any difference in terms of maybe even the risk profile for the loan that they're actually a subscription-based business versus like a one-off or relying on a lot of seasonal business for their revenue?
Absolutely. And in multiple ways. If it's a seasonal business, that's a risk factor right away. And that ties back to the earlier part of the discussion around working capital, right? If there's a very large dependence on 3 or 4 months of the year for that
Right.
business to realize most of its earnings for the year, that is a risk factor that we have to incorporate into our analysis. How they get paid as well. We'll look at the agings reports and try to get an idea of how well are they collecting these payments. I'd say the other big factor here is other service, like do they only provide tax professional, like tax prep, or do they have
Mhm.
some CAS related offerings as well? We'll look at the revenue composition
Mm.
writ large for each firm. But you actually, in our line of work, we go even further than that. And even if it's a tax prep firm, there's a big difference if that firm primarily does 1040s and individual returns versus if they do primarily business returns and 1120s. And even within that, what's the age of their customer base? You know, do most of their customers on the higher end of that age distribution? These are all factors that can play a role in that valuation. And then by extension, our overall analysis of the strength of that deal. So these all play really critical factors or roles in determining the overall risk profile of the deal. I wouldn't say a tax only firm is necessarily a high risk deal, but there are more risks to be aware of that we just have to feel very comfortable about in the sense that they're sufficiently mitigated before we end up closing and funding that loan. But
Sure.
we certainly like to see some diversification of the revenue. It's great if they can do bookkeeping and tax. It makes, I think, that business more sticky to its customers, right? If that business is not just doing your tax returns, but they're also preparing your monthly financial statements, if they're also providing tax guidance, if they're providing some kind of CFO service, right? These are all things that can just increase that overall value proposition that business provides to its customers. So I think it's an emerging trend. I think when you look at these growth oriented businesses, folks who are really dialed into that type of those things and putting the pieces in place to diversify revenue.
Yeah. It seems like Eric, there's a lot to keep track of, particularly with M&A and particularly on not just what makes it successful, but what makes it unsuccessful, particularly with deal killers. What are some of the top deal killers with a lot of these transactions, particularly for accounting firms these days?
Yeah, great question. So I'd say the first is just deal structure. And even if you back up before that, just at the end of the day, we talked about, I mentioned the point earlier, these are goodwill based companies. So
Hmm.
the value doesn't come in some widget that sits in a warehouse or some IP based off toiling in a lab for years and years on some R&D. These are relationship driven businesses, and the value of these businesses, generally accounting firms, bookkeeping, tax, are the relationships between the the firm that provides the service and those who need that service. The reason I say this is it's if you look at a particular opportunity, there's a buyer and there's a seller, there's a relationship there. And that has to be a pretty solid enough relationship to be able to get that, not just get that deal over the finish line, but also to ensure that it's a successful deal after it closes and successful for the buyer and for all of the stakeholders, including the bank, right? So those relationships are so important. And if you have a deal where there's just a lot of tension and it's impossible to negotiate terms and there's bad faith and I've seen that. And that, by the way, then translates most of the time into bad terms in terms of just the way that the deal is structured. So, for example, if a deal doesn't have what I think is an alignment of incentives, right? So if a deal doesn't have a seller note or some kind of escrow holdback, it's common. These are in my experience, these are common features to have as part of a deal. So in other words, you want some downside protection for the buyer. If revenue plummets or falls off a cliff in year one, why is that happening? Most of the time when an accounting deal goes bad, it's typically tied to the transition. And so that can
Sure.
be usually one of two things happens. One, most commonly, right? I'm painting with broad brushstrokes here, but number one, there's just malfeasance by the seller. So post-close, the seller now tries poaching customers, even if there's an
Yep.
NDA or not an NDA, a non-compete or a non-solicitation in the purchase agreement. Some states, and I think there was a ruling last year by the FTC that a lot of these non-competes are non-enforceable, and it can
Mhm.
vary from state to state. But I've seen cases where a seller just does this anyway and basically tries to play a game of chicken with the buyer. And they say, yeah, I know I'm doing it. Sue me. It's not a game you want to be playing. So you can avoid all
Yep.
these things or a lot of these risks with having a solid deal structure up front. So that's a common one. But I also think just not having a good game plan in place, or if it's a good enough game plan, not having the execution after the deal closes, right? So uh, we take a very close look now at just the experience and acumen of the buyers. That's also really important because we're seeing a lot more these days of non-accountant, non-CPA buyers. I think other industries, other buyers are looking at this industry and seeing the value, seeing the essential nature, while we still have an IRS of these services. And we're seeing finance backgrounds, but not necessarily CPAs or EAs stepping in. We're also seeing a lot of wealth management firms stepping in and
Yep.
wanting to bolt on an accounting or tax type of practice to provide additional value to their customers. Anyway, so I'd say deal structure is the most important thing, but the negotiation and the relationship between the buyer and seller is really critical. The other thing worth mentioning on that point, a lot of these deals are brokered as well. So oftentimes there's a broker involved who can act as an intermediary for better and worse between the buyer and the seller. And so
Do you
there's
recommend brokers in most occasions?
I do. I think that the good thing with brokers is that they know what the ones who have a ton of experience in this industry, they know what the purchase prices are, so they can set expectations accordingly with their clients, who are oftentimes the sellers most of the time. They can help just move things along. But there's pros and cons too. From the biggest drawback for the seller, at least, is these are not inexpensive services, right? I think most brokers command a fee on the overall sale price of somewhere between 10 and 15%. You're talking about a $2 million firm. That broker could be walking away with $250,000. And I'm not saying it's not worth it or they haven't earned it,
Yeah.
but that is a sizable expense for a seller to have to pay for all of the work they've put in over the years. But we love working with brokers. They're an important referral source for not just us, but for pretty much most of the banks that lend to the market. But they're not all created equal. So I would just be very
Sure.
careful with the other thing I would add too, just on deals going bad, having not just the broker, but just the overall deal team you have in place is really important. And that can easily derail a deal as well and prevent it from closing. So that's the attorney, that's the bank. If you're using a bank, frankly, you should be talking to an accountant or tax professional as well, right? There's implications when you're buying and selling a firm on your personal taxes. You want to understand what those are, and that will in turn potentially impact how you want to structure that deal. So these are the real common items. Not to get too far in the weeds, the terms matter as well, like NDA, or I keep saying NDA, non-compete. What are the
Yeah.
terms? What's the distance? Is it the whole state? Is it the 50-mile radius? What's the timeline there? When does it expire? Key man risk is really important as well.
Sure.
That's the other thing when talking about transitions, I forgot to mention. If it's not seller malfeasance, it can be employee malfeasance too. And that's a little bit
Yeah.
harder to combat, right? You can't really, as a seller, you can't control as well what your employees or former employees do after the deal closes. So that's another thing.
Sure. Yeah, absolutely. And if we were in a situation where we were doing one deal a year. It obviously, the more you do this, the more you learn it. But I think for most folks, particularly in the audience, it's going to be something that it may be a one in a lifetime opportunity or transaction. It's not going to be very frequent. So there's a lot of things to understand. And then you almost have to, it's forgettable because you're not really doing it that much more. Obviously, there's an application process to go through, but is there any kind of pre-assessment or even like a calculator that folks that may not be ready to just fill out that application or have a direct one-on-one conversation yet, is there any like tools or resources or assessments that you're aware of or that you offer that folks can use like on an early basis before they really dive into filling out that application? Or is it more about having a conversation directly with someone like yourself?
I would encourage that last thing first, only because even if the numbers, you can have the most perfect calculator in the world and the numbers look wonderful, but there's so many qualitative components
Sure.
here that notwithstanding a perfect quantitative profile of the deal, it might not be a good fit either for an SBA loan. It might not be a good fit for that particular borrower, that customer. So I do think a conversation initially makes probably more sense. And then from there, if it sounds like things are in alignment and there's something there that likely can get done, yeah, we can share. We have some, our search team has some pretty good models I've used to send to folks in terms of putting a cash flow model together to basically put some preliminary spreads for a deal and see does a at a given purchase price with certain assumptions in place, do the numbers pencil out? Does the deal make sense? That is something I encourage folks to do. Just I always love, as I'm sure every tax professional does with their clients, right? I love working with prepared customers who've done their
Sure.
homework, who have everything ready to go. That makes things a lot easier. But I also think it has the benefit of just arming a potential applicant with that information to know where they stand, knowing in advance how their deal is going to be underwritten, what are the numbers we're going to look at, and where do they fit in that analysis. That's only going to help.
Sure, sure, absolutely. And yeah, we dived into a lot of these topics today. I want to maybe end out with just there's tons of banks out there, tons of banks that do SBA loans. How is Live Oak Bank different? And I may even be as bold to ask, is there anything that you guys do that other lenders don't? And that's okay if not. Maybe just talk a little bit, not to put you on the spot, but
No,
you understand it's a very competitive space. And this is something that I'm not super familiar with the area, but I'm sure there's even online websites that you're comparing SBA loans, you're comparing banks and rates and things of that nature. So what makes you guys different? Is there anything in particular that sort of,
I think there's a few things, and I think it ultimately ties back to the culture at Live Oak. So I mentioned my team, we just focus on accounting and tax deals. That's really our focus day in and day out. I start with that because if you're a generalist lender, not that there's anything wrong with that, and we have generalist lenders at Live Oak who don't have a particular industry niche that they focus on. But if you are a generalist, you're not going to understand some of the nuances and the industry specific risks attached to buying an accounting and tax firm. And given that these are really the only types of deals that myself and my colleague Steve look at day in, day out, and by extension, the rest of our team, our underwriting team, our closers, our servicing team, it really lends itself to knowing more about these types of businesses and then how to structure the deals to put everyone in a position to succeed. And I think that's a huge differentiator for us. Now, to your point, there are other banks that have teams that focus on accounting and tax firms, but we happen to be the number one SBA lender in this industry if you look at the fiscal year for 2024. And I don't make that point to brag. I really don't. There's many of the other lenders we have good relationships with. Sometimes there's deals we can't do for whatever
what do you
reason.
mean by number one in terms of revenue or
I'm sorry,
transactions or,
in terms of loan origination. So we have
okay,
originated in terms of loan production, dollar loan production. So from FY basically the government fiscal year runs from October 1 through September 30th each year. So for FY24, we're the number one, and we've been the number one for many years. The reason I make that point really just ties into the fact that we have the most experience. And so I encourage, by the way, everyone to talk to multiple banks, just like if you were buying a home. You wouldn't just, I hope, talk to one lender and
Sure.
sign that loan offer right then and there. You want to get an idea of what is it like to work with that bank? What are the other add-on services they have? Do they have a good deposits platform? It's not just getting the loan. There's other factors here. The other thing too is, what's the future look like? Are you going to buy one practice and call it a day, or do you maybe want to buy multiple firms? So that's another really important question I encourage folks to ask, because we can often go well above our, so most SBA loans or lenders, they'll stop lending to folks once they hit $5 million in outstanding SBA debt, 7A debt.
Right.
We can typically go above that. We can add conventional debt on top of that. So I am of the opinion that one of the other differentiators is we can help with people's growth aspirations where maybe they've exhausted their SBA 7A lending runway, and now they're in conventional territory. And that's something you want to be aware of upfront, because if you find yourself in a position where you've maxed out and now your bank won't work with you and you want to continue to grow inorganically, now that can be a limiting factor. The last thing I'll say is that our culture is, I think, a little bit different in a really different, special way. I think that we're still founder led. We were started in 2008. We go and see each and every one of our customers, both on the front end. When I'm preparing a deal, I fly out. I'm based in Washington, D.C. I'm going to fly out to my customer. It doesn't matter if they're in California, in Alaska, Hawaii. In fact, I'd love to go to Hawaii, in fact, but I'm going to go and meet them and look at them eye to eye and get a sense for what kind of person is this? Do I want to do business with this person? And I think that's uncommon. I don't think every bank does that. And then our servicing team tends to go out and meet after the loan closes and make sure we're taking care of them.
Yeah.
So those are
Now,
just a few things, but
yeah. And Eric, you mentioned loan origination. Where are you originating right now? Is there a public number that you have that you
yeah.
guys put out?
Oh, yeah. And I mentioned the SBA data, right? In 2024, sorry, in FY 2024, Live Oak generated it's 42 million in loan,
2 million.
or million, and just some of the overall numbers just on the 7A program, just in case you and your folks might be interested. So overall, the program itself puts out, each year, they do about anywhere from 20 to 30 billion, not just for accountants. This is just the 7A program writ large.
In general,
Each
yeah.
account in general, about 1% of that goes to CPAs and accounting firms.
Still small, right?
It is small, but we're talking about the entire United States economy here. So every business that gets a 7A loan, that boils down to about 300-ish, between two to 300 million per year in SBA 7A loans going to an accounting or tax firm. And then the average loan size is around, for Live Oak, it's around 700 or 800,000. Whereas for the broader, if you zoom out, for any lender making a loan to an accounting or tax, it actually is a smaller average. It's around 400,000, 500,000. So,
Got it. Now, last question before I let you
yep.
go. Some accountants may not be ready for a SBA loan, but maybe they have clients that are. Do you have any particular referral programs that you offer for the accountant or someone that wants to refer a business to you guys? And what does that look like?
100% we do. We rely on that quite heavily. I mentioned we're often working with brokers. Sometimes it's not a broker. Sometimes it's, to your question, CPA. And those who work
Mhm.
with businesses, they frequently are approached by their customers and are asked, hey, do you know a bank I can work with? Or I'm thinking about buying this firm. Can you provide guidance? So we tend to pay, industry standard is about a percentage point on the amount of the loan that we end up closing as a result of the referral. I'm more than happy to get into the details with anyone if they want to talk through it, but we love referral sources. And frankly, I, regardless of whether or not we work with the customer or not, I recommend to them to talk to a few lenders, because you can add another source of revenue as a practice
Yeah.
owner. Yeah.
And is it easy to set up? Is it like an online
No,
form or code or something like that? How does that? get
Because
set
it's
up?
B2B, yeah, there's a referral agreement that I'll share, and that was fairly boilerplate, but they would sign, and then we get them set up as a vendor. And once we close a deal, we'll issue a check or an ACH to them, and it is pretty smooth and straightforward.
Got it. Got it. Okay. On that note, I think that's a great way to close. And speaking of which, so if someone, loved what they heard today, they want to have a deeper conversation, what's the best way to get in touch with you? Is it LinkedIn, email, website? What's the best way to get in touch?
Yeah, so I am on LinkedIn, so I encourage folks to I post as often as I can. I probably could do better. And so LinkedIn is a great option. And then just email or phone calls. I don't know if you can throw my phone number in the show notes or email, but you can find my email address on there. And on LinkedIn, there's a link actually at the top of my profile where you can actually book a meeting with me. And I'm happy to have a conversation with folks that way. I'm looking forward to any conversations. By the way, there's no cost to talk to a lender unless a deal closes. At the very worst, it's free information.
Yeah, and in all honesty, I found you on LinkedIn. Like I said, this is a bit of a abnormal show. I usually focus on accounting firm owners, but I think you have something interesting that a lot of firms are not fully aware of. So I'm glad that we had a chance to deep dive into a lot of these other options and even alternative options. Eric, thanks for being on the show. It was a pleasure to have you today, and maybe looking forward to have you again in sometime in the future.
I appreciate it, Mark. Thanks for having me. It was a pleasure for me as well. Take care.
Yeah, take it easy now.